Some major bearish reversals in the lower 100s slowed down the long-term uptrend. That eventually did make progress for a mainly bullish decade. More recently, bullish sentiment has been so strong, a steep incline has prevented gaps from being filled. An aggressive uptrend undergoes a correction following the swift completion of a compact double top that originates from the opening prices around 173 from a pair of overly bearish candles. A downtrend develops with clear ranges of support to reference, such as the gap up open, gap fill level, and recent upswing points around 148. During this time, Caterpillar stock and the broader stock market are in a period of high volatility, yet trading still takes place in clearly defined ranges. To highlight the simple yet effective identification of support and resistance that is enhanced by chart pattern analysis. The recent support ranges have less strict triple and double bottoms. This kind of price action can partly be attributed to the volatile period that still presents a neutral to bearish tone, especially with the past week of increased selling back into the 140s. It is a strong drop, but the gap up has a delayed fill. This is again due to volatility that can affect the use of even simple gap patterns. There is also influence from the minor upswings in November 2017, following the gap up. It is not uncommon to see upswings in a gap range that is not immediately filled, having an influence in slowing down a drop back into the gap range later on. A small but strong double top has reversed the moderate uptrend from August, and now attention returns back to the 131.68 close price of the gap fill candle. It is a strong downward continuation, but not surprising given the persisting bearish reversals following the steep incline in 2017. The gap down taking place under 131.68 did exhaust selling too much in a short period, and that is a large part why the market moved into a flat phase following the passive rise off 113.24 in the face of clear selling pressure that still remained. Here is a good example of a head and shoulders in the context of a horizontal range, following a minor uptrend. This kind of price action is often the result of overexhausted downtrends, such as the one towards late 2018. As usual, downtrend lines from the head and right shoulder are useful in gauging the progress of an uptrend. In this case, there is also a shallower and helpful downtrend line from the shoulder level as well. At this stage, there is natural long-term resistance, especially nearing the major 140 level. It is also apparent selling pressure remains, but to a far lower degree. Short-term bullish sentiment is moderate at best. The few minor green spikes only serve to hold trading in the 130s, and not continue the uptrend. The large red candle starting August was a clear break in the gradually bearish context seen by the short-term downtrend lines. However, the head and shoulders was less clear, due to it being slanted and the one large red candle starting July giving the bearish reversal the qualities of a double top. Incidentally, the shoulder level for the first head and shoulders is the same shoulder level for the second head and shoulders, if the shoulder levels are defined by closing prices alone. In this case, using closing prices to define shoulder levels is acceptable, since the large red candle that started July had above normal volume. As usual, previous ranges and trend lines are helpful as many swing points develop at or near these landmarks during a later recovery to resume the climb to newer highs.